Good morning, everyone. This is Barry Knapp from Ironsides Macroeconomics. It's Monday morning, November 18th at about 8 a.m. East Coast time down in Florida. On my way to Tucson later this week. As a note, there will be a delay in this week's note. I'm not going to have time late this week to get it together. We'll do it when we get back to Colorado on a Sunday. So you'll probably receive it a week from today rather than the typical Friday morning time. So our note this week was titled Our Dollar, Everyone's Problem. There was lots of discussion over the weekend. It almost seemed a little bit of post facto that the weakness in the equity market had to do with the debate about who's going to be Treasury Secretary. And while we think that may have been some level of concern about that. That's not really what we think was happening in the markets last week. From our perspective, 10's getting close to 4.5%, 10-year reals or tips well through 2%, and the strength of the dollar in particular. If you're watching this as a video, you can see the near-term forward spread, which is a measure of Fed expectations, has steepened considerably. It hasn't quite disinverted, but that's taken the dollar with it. And in recent years, monetary policy has played a very considerable role in the direction of the dollar. You may all recall the start of this chart is back in September of 22 when we think we hit what we define as R double starred, or the financial instability rate, when the Fed raised above 3%, turned carry on their portfolio negative, which was also true of a bunch of the big banks, set off a sharp decline in the yen that the Japanese needed to intervene to the tune of $21 billion or so, caused a flash crash in pound sterling, U.S. mortgage market to go bidless. The Fed's seemingly turned towards a more hawkish stance. The repricing of the terminal rate forecast, much closer towards our expectations of 4%, has led the dollar higher. And as we know, the dollar can be an absolute global liquidity wrecking ball and can trigger weakness across just a broad range of assets. And so that's what we think is really going on and why the market struggled. So the note this week began with this discussion of dollar disruption. We then reviewed the inflation data from last week, inflation week. We then discussed monetary policy, the debate that they are seemingly having about where the real rate or terminal rate should be, neutral rate, if you will. There was a little bit of a revisiting of productivity discussion in there because the Kansas City Fed president, in a speech, spoke about churn within the labor market, potentially creating a cyclical surge in productivity, which may then fade. This is something we've written a lot about. We were thrilled to see that he had picked up on this. And so we took the passage out and discussed that a little bit, and then wrapped it up with our latest thoughts on the Trump trade. So just to begin, we do not think that President Trump is inheriting a great economy. We reviewed earnings a little bit and noted that S&P ex-tech and comm services earnings growth was only 4%. It's only expected to be 6% next quarter. That's not exactly robust mid-cycle type growth. And the Russell 2000 is still a problem. The one-year forward estimate through earnings season has fallen from negative 10.5% to negative 14.9%. That's 1 year forward. The problems in the small business sector might be alleviated or helped to some extent by more favorable tax policy, but the real issue is monetary policy. And we noted a quote from the NFIB survey that said, the average financing rate came down from 10.1 to 9.7%, but 9.7% financing rate for small businesses is quite prohibitive. And we do really need a fairly painless disinversion of the curve to relieve all that pressure on the supply of credit as well as the price of credit. So getting the Fed to ease is crucial for stabilizing small cap and small company earnings, highly leveraged company earnings. We then moved on to a little bit of a discussion of the policy sequencing. So there is a continuing resolution that matures or expires on December 20th. And what the Congress decides to do with that is going to be crucial. If they do their typical, um, you know, let's do an omnibus spending bill and extend it all the way out till next September, that would be a negative scenario in our view, very similar to what happened in 2017, where the Trump administration got bogged down in Obamacare repeal and replace and didn't get to tax policy for a full year. That made things a little more difficult in the first year of the Trump presidency than they needed to have been otherwise. So we have a similar dynamic now. Clearly, they're not going to get bogged down in Obamacare repeal and replace from a legislative perspective, but we have the issue of tariffs and taxes. So if there is another CR, continuing resolution, that pushes the tax debate out a couple of months, and at the same time that they're implementing increased tariffs, they're also addressing tax policy, markets may be able to look through the disruptive impact of tariffs, which will undoubtedly push the dollar higher and exacerbate the current liquidity situation. Of course, that does depend on what the Fed's doing at that time, what happens with the labor market, but we're just trying to make the point here that this taxing and tariff stuff needs to happen virtually simultaneously for the markets to get the carrot and the stick at the same time. So that's just something we wanted to raise and get people to start thinking about. As far as the inflation data goes, we viewed the CPI report as in line. We were always likely to have a bit of a seasonality issue here. We're comping against some very soft numbers from a year ago. We're not worried about goods prices in the least. We still think there is issues with respect to supercore, non-housing services. That comes from the fiscal theory of the price level, of fiscally driven inflation, government wages running nearly 100 basis points above the private sector, government employment growth running nearly 100 basis points above the private sector. So there's issues with inflation, and we don't think it's going to get easily back to the Fed's target. But we don't think there's a reason for them to be pausing in December because PPI and import prices were a little hotter. By the way, import prices haven't picked up is not going to persist with the strength of the dollar that we're currently seeing. So yes, we may very well get a 0.3 on core PCED at the end of the month, but it's not a reason for the Fed to pause. They need to get to 4 sooner rather than later. And that really just took us into the next section where we discussed the terminal rate, our view of why we think they need to get to 4 based upon the banking system, based upon painlessly disinverting the curve. Fed seems oblivious to a lot of those issues other than maybe Kansas City Fed President Schmidt or Dallas Fed President Logan. We're still anxious to hear more from Cleveland Fed President Beth Hammack. We suspect she'd be cognizant of these same issues given her background at Goldman Sachs on the trading side of the firm. But that notwithstanding, that's where we think they need to be getting to sooner rather than later. And were they to skip December, for example, that would, in our opinion, be a very big mistake. So I did touch on that productivity discussion. If you're a full subscriber, you go and have a look at that. We thought it was interesting. But one of the points we've been making around the productivity outlook is there is some evidence that we're getting accelerated technology innovation adoption like we got in 2018 and 2019. And we see it, we've tried to measure it through sales per employee deflated in the various S&P sectors. And so there's some evidence we're getting more technology adoption, and we may be getting stronger total factor productivity growth, which is the technology component of productivity. But President Schmidt brings up a good point that we had brought up previously, which is that big churn we had in the labor market from mid-21 to mid-22 caused the surge in productivity as employees settled into their jobs. Some 2 years in, they're at their maximum point of productivity before they get to the inevitable grumbling, hey, I don't like this job that much, I want to move on, but they're sort of trapped now because churn has collapsed. And whether we're getting a cyclical turn in productivity or more of a secular trend is a little bit unclear. And that is a major issue for 2025, is do those strong productivity numbers persist or do they fade? If they fade, that means weaker profit margins, slower earnings growth, and a problem for equities, particularly if the Trump administration doesn't get the sequencing of tariffs and tax policy correct. So wrapping it up, we don't really think the issue is about the Treasury Secretary here, though not that we don't think it's significant. We've written quite a bit about how important a Treasury Secretary is given the size of our debt, the issuance. In a lot of ways, the position is as important as the Fed chair, which is something that wasn't true for the last few decades. So that is a crucial decision, but we don't really think that's what drove the markets last week. We think it had more to do with rates getting to uncomfortable levels, tightening of dollar liquidity, certainly the pain in the healthcare sector, which is something that we addressed by downgrading the sector before we got to the RFK appointment. Of course, the group got shellacked, and if anything, from this point, we'd be tempted to even reduce our exposure to zero in the sector because we do think it does need disrupting. We've been on the wrong track with this sector for a long time. 30 years of lower, successively lower profit margins in the sector ought to get you kind of scratching your head as the price goes up. But bottom line here is, we're into a favorable period of seasonality for equities, not so much for fixed income. Trump administration has to get all this policy stuff right. They were not left with a really great hand by the Biden administration. There's some serious problems that need to be addressed, and the Fed needs to continue the recalibration process as well. So that's it for me this week. Again, I apologize for next week's note being a little bit delayed, but got a golf member guest to play in down in Tucson this week, and this is a mini break for us. So have a good week, everyone. Thank you.